10 buyer conceptions. When you start looking for a home, you have several misconceptions most of the times that you bring along when you're looking for a home. Today's video is going to talk about it, not necessarily in the order of importance. So do watch to the end. Hi, I'm Amol Heda with Keller Williams Bay Estates and author of Thriving Through Ownership. I'm going to talk about 10 buyer misconceptions that they bring along. And I'm going to divide them into 3 different sections so that it becomes easy for you to digest how it goes. So the first one is about mortgages. Most people think that they need a lot of money to buy a home. Totally far from truth. I have done transactions and lots of them where most buyers were earning very well, but they did not have the money to make the down payment. So I have helped people buy at 3.5% down payment, 5% down payment, 10% down payment, and so on. What that does is helps them get into their own home early, start capturing appreciation, and enjoy living in their own home. The second myth and the misconception that a lot of people have is they will wait until they can collect a lot of money and feel more stable. So that's actually very inverted way of thinking, because the sooner you get into your home, the sooner you start living more freely on your own and start building equity on the financial side. So in fact, if you keep waiting for that money to come and happen for you, you will tend to get behind because you will leave the appreciation behind. The third myth about mortgages is you need a perfect credit score. Credit score is a very good thing and a very important parameter when you are trying to buy a home. And I help my clients with low credit, with somewhat good of a credit, and very good credit. So the way that this works is, credit is a pretty complex thing. It's essentially a couple things: your ability to borrow, and it's your ability to know how much you can borrow. The number itself tells the lender as to how much a person can borrow. Two factors essentially drive the credit score. One is your ability and a practice to keep paying the lender back. So it's the attitude. It's not the income that matters. It's whatever income you have, are you paying your commitments regularly? That forms a big part of the credit score. The second is the amount of eligible credit that you have. Out of that credit, how much are you using? Because the amount of eligible credit if you have, and if you're very much drawn, then you have very little remaining. So that's the second important part of a credit score. Then type of mortgages or type of debts that you have, like an auto loan, a student loan, a store credit card, a home mortgage. That determines, but that makes it a smaller portion. So in fact, the sooner you get more number of debts and you keep paying them regularly, the better credit score you get. So don't wait for the credit score to get perfect. In fact, getting into your own home sooner will get you a better credit score and better ability to pay, and it will establish you much better. So don't try to get to a perfect score, because that perfect score does not come without the habit of paying, the habit of borrowing, and the lender's understanding that you can do these things. The last in the mortgages is people think that they should find a home first before finding a lender. Or some people have a misconception that they should have a pre-approval in their hand before they can start looking for a property. Both the approaches have their own positives and negatives. My advice to my clients is to first go start seeing properties. Because if you start first going for the pre-approval, a lot of people go get a pre-approval letter and then keep looking for 3, 6, 8 months. I have done as long as 4 years. It has taken 4 years for my clients to close. So then the pre-approval would expire every 3 months. So how many pre-approvals will that client take? 12 or 16 if they expire every 3 months. Now that's going to ding your credit score. Every pre-approval that you do without taking a loan dings you. And so it's a better approach to first get at least somewhat serious about your properties. And once you're serious about these properties, then you jump out and get your loan approved and then get your transaction going. So these are some 4 important ways that buyers come thinking, but they should actually be thinking the other way around. Now let's talk about the transaction itself. The first and very important one, and I'm an agent, so I'm going to bring it up, is people think that they don't need an agent to buy a property. I think this is the most misleading concept that we can go into the market with. Of course, the listing agent is there. He has his commission decided with the seller. And the listing agent, he or she, will also have a participating commission for putting the property on the MLS and for the buyers' agents to bring their buyers. So, if you are having your own dedicated expert real estate advisor, you're not paying the commission. The commission is being paid by the seller. And the listing agent has already put it up as to how much commission is going to be split between the listing side and the buyer side. And even if you don't work with a buyer's agent and you go straight work with the listing agent, guess what? That listing agent is actually representing the seller. And do you know whose interest that person is having at heart? The seller, who is paying this much commission. So do you want to go and work with the listing agent? Yes, we have seen those very competitive cases where people thought that if I don't work with a listing agent, I won't get the property. Far from truth. It's not that just the listing agent can only care about the commission that they are going to make. There is that seller who is going to realize the money from this transaction. So whatever you are paying, the listing agent does get part of it and will get more if you decide to choose to work with the listing agent. But the seller determines whose offer to select. Now, if someone else goes and writes a higher offer than what you have written, what do you think will happen? The seller is going to say, oh, I want that offer. Or if your offer is getting selected, seller has selected it because they like your offer the most, not just because it came through the listing agent, but because they're realizing the most money and it's being represented by the listing agent. So, you are actually playing very closely into the hands of the listing agent. If you think you can work with the listing agent who represents the seller, feel free to do so. But I believe it's much better to have a professional buyer's agent represent you full time and look out for your own interest. Next, a home buying transaction is very easy, completely far from truth. When I do a transaction, I always tell my clients that I won't congratulate you when you are getting your offer accepted. Most people think getting an offer accepted is done. No. I always tell my clients that the agents that work in between get their money for that distance between the lip and the cup. It's very small. You might think that, oh, now that my offer is accepted, the house is mine. Completely untrue. I, in fact, keep advising my clients that think of it as a first trimester. Until your inspections are done, until your contingencies are removed, after your loan has been approved, final approved, do not even think that you are going to get the property. In fact, getting in contract just means that you have a right to get the property if all goes well. If anything fails, having contingencies enables you to back out of the property. If anything goes wrong, you can get out of the property. The seller cannot. So, it's very important to realize that a real estate transaction has a lots of steps, and each one of these is important and can go foul. And so, do not consider it as a done deal. It's far from a done deal when you are getting into a transaction. The other thing, and this applies a lot more to the techies out here in the Bay Area, they think that Zillow and Redfin are the best portals and give the most information that you need to complete a transaction. The home values that they give are accurate. I just have one question. Go find out how many transactions actually close at a Zillow or a Redfin valuation. So these are numbers, just like the buyer comes with their own number, the seller wants some other number, the appraiser comes with one more number, and there are multiple buyers, in fact, offering multiple numbers. So just imagine, in this maze of numbers, which number is really the right way to go. I always recommend that you work very closely with an agent you trust. They will give you the best, help you get the best deal possible. And that's what makes you the most money. It's the market timing, it's how things will flow, and it's the pricing guidance and how the neighborhood is going to work for you. All of these aspects. There is another aspect of a transaction, and that's buyers tend to try to think that they should drive the transaction. Guys, when you are a buyer, how many transactions have you done during your lifetime? So they try to think, oh, let's start low and then let's keep room for negotiation. Oh, let's keep all contingencies, or let's keep no contingencies. All of these things should be done with the help of your trusted agent. They know the market. So just like 5 months back, we were writing offers million and over the asking price. And now we are at asking or even below. I did my last video, you can watch that. Do you think the market remains static? If the market was static and that easy to understand, you wouldn't need anybody to make sense of it and to get you the perfect deal and in a very right, smooth way. So that's where your agent steps in to help. Now let's talk about properties. People think younger the property, the better it will appreciate. Totally far from truth. And I have been helping my clients understand and flip their thinking on this particular matter. In fact, the younger the property, the lots, the locations were very difficult to build when the boom was going on in the 70s and 80s. The properties that were built during that period had the bigger lots. They were at least 6,000 and such here in the Bay Area. They were not located in very busy areas or next to busy streets or in industrial locations or in contaminated grounds like where an industry was pulled off and then it was contaminated with the chemicals that the industry used and all of that. Those properties were not built. Those lands were not buildable at that time. And so, the more recent the properties, particularly here in the Bay Area, they were not buildable lands. They were by the freeway where they would not build during those periods. And now the lot size have been getting smaller and smaller. Completely granted that these properties look new, are fitting the interiors and exteriors, fit the current fashion trends in home building. They are very attractive, very appealing to the young generation, to the millennial, to the Gen Y, to the Gen Z. But these properties don't come with the fundamentals like the most land, because land is what we cannot manufacture. We can manufacture multiple properties. We can take a property, convert it into two, or we can build on land that was not buildable hitherto. But, so that is what. So these newer properties come with smaller land, tighter and tighter lot, no air and ventilation or light to some of those. Like a townhouse has only one side open for light and air. How good of a value would that be? So that's what people think. And yet, remember, we pay about 25% more for a comparative matching single family home versus a newer home because it's new. We don't continue to think, we don't think deeply that it's the land that gets value. It's the light and air that you will be enjoying every day. So a lot of people think that a newer property will have much less maintenance. It does indeed have much less maintenance. The insulation in the newer properties will save you a lot of electricity bill. The way that these homes are built, they come with the most modern amenities and all of that. But remember that a home is not a car. It does not drive 100,000 miles. It did not go that much distance. And because a home does not have a lot of moving parts, the home does not need maintenance the way a car needs. The last purchase that people did was a car, and they try to think that, oh, that's how we should think. Older the property, more the maintenance. And because it's a property, it's a $2 million property, the maintenance will be in proportion to that price. Not at all. Plumbing costs $7,000 to replace entirely. A foundation crack these days costs maybe $10,000 to $15,000, or depending on what you see in the inspection reports. But all these costs are very small as compared to the cost of the home. So I'll highly caution you. One slogan that I have built during my real estate practice for last 2 decades is, I tell people that you're going to like a home the age of your marriage. So if you just got married, you want to go into a brand new home. If you're 50 years married, you don't really care how new or old that home is. But that's a joke. And jokes apart, younger homes are not the ones that really keep money into your pocket, contrary to what you think. Last one. Appreciation is dependent on how the home looks. Completely false. When we help clients buy properties, they buy properties based on their multiple of their income. Now, let me explain to you. Recently, when the interest rates were at 2.5 and 2s, low 2s, my clients were qualifying at about 8 times their income. So suppose they were making $200,000 in income here in the Bay Area, they could qualify to buy a $1.6 million home. Now, do you think a $1.6 million took really that much to build? That $1.6 million was a 50-year-old home built in 1960, about 1,600 square feet. But this home was about 25 miles away from the area where the most highest income people live. Now get this right. People here in Silicon Valley typically make about $150,000 in income. And if both of them are working, they're making about $300,000 in income. Now, if they qualified for 8 times their income, it means they qualified for $2.4 million of a home value. And that's what puts the price on the home. So it's the buyer who determines the price, not the seller. It's not that like a car, you have 400 nuts and bolts, a piston, 4 tires, a body, and so if everything costed 400 nuts costed $2 per nut times 400, the piston and the engine costed $3,000, the body costed $5,000, and so the car became $15,000. No. That's not how real estate works. It's the exact opposite. It's the buyer who determines what they pay. And so, the affordability of the buyers is what drives the real estate prices. Guess what changed? And suddenly, the home value started jumping down 15 to 20%. It is the buyer's affordability, because the interest went up from 2.5 to 5.5. Almost a double jump, or more than a double jump. What did that do? That brought the affordability down. And the moment that affordability came down, people could not offer the same price that they were offering just 5 months back. So, if the interest rate starts coming down again, and the incomes keep going still, these two factors will drive the housing values, not how good the house looks. So guys, focus on being in the area where there is the most income growth. Do not focus on areas that are far-flung, that will cost you 3 hours per day to commute one way. Like people drive 75 miles from here, where it is the work center, and they pay for gas and they pay for in the form of the time they are away from their family. So the people that make the most money, they live closer to their work. They live closer to where they make the most money. And that way, they get to enjoy the most amount of time with their family. And that's what gives them the most money in the house value appreciation. Let me close with just one note, that home values appreciate the most, not because the color was San Francisco fog or there was Calcutta marble in the kitchen or there was a completely redone bathroom with floating vanities, a standalone tub, and much more upgrades. It is how much income is flowing into the area, and that flow, you have to have your home in the way of that flow, and that's what is going to hold value on your property. Do you think this makes sense? I think you should watch this episode multiple times, and if you think you find value, share with your friends. As always, I will keep bringing such valuable content. Hit subscribe and click on the bell button. Talk to you on my next one. Bye.